Disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, let's dive into this explainer. Today, we are putting Nomura Holdings Q1 earnings beat under the microscope. We're looking at a quarter driven by massive macro tailwinds in Japan and what management claims is a newly revitalized corporate structure. Look, legacy financial institutions rarely post this kind of delta overnight. So as always, we need to be objective, tear these statements down, and see exactly what's really under the hood here.
Here is our roadmap for today's case study. 1. Nomura's blowout first quarter. 2. How the wholesale division is driving growth. 3. Record highs in wealth management. 4. The Japanese market macro tailwinds. And finally, number 5, their upgraded targets for 2030. Let's get to it.
Section 1. Nomura's blowout first quarter. A stunning start to fiscal year 2027. Right away, this headline number practically slaps you in the face. 96%. That is the quarter-over-quarter jump in Nomura Group's pre-tax income, which came in at 211.5 billion yen. Think about the sheer scale of that for a second. Nearly doubling pre-tax income sequentially requires massive, and I mean massive, operational leverage.
Let's look at the metrics across the board. Net revenue hit 686.7 billion yen, up 19% sequentially and 31% year-over-year. Net income tracked right alongside that pre-tax income, surging 97% quarter-over-quarter. But for us, the most vital indicator of their true capital efficiency is return on equity. They hit 15.4%. That's the highest ROE they've posted since mid-2020. This isn't just a revenue bump, it's highly efficient flow-through to the bottom line. So naturally, management is taking a bit of a victory lap. CEO Kentaro Gura noted that this broad-based momentum basically proved their structural reforms from the past few years are finally bearing fruit. From their perspective, the structural transformation and closer group-wide collaboration are translating directly into this higher profitability. Moving on to Section 2, Wholesale Division Drives Growth, Trading and Investment Banking Surge. If you look at the far right of the wholesale column on this chart, you can clearly see net revenue accelerating to a record high of 369.1 billion yen. That aggressively dwarfs the previous 4 quarters. We are seeing an upward trajectory here that completely breaks from their historical baseline. When you're modeling this out, it's absolutely crucial to note that this single division now generates over 50% of Nomura's overall income. The operating leverage is fantastic. We've got revenue increasing over 40% year-on-year, which drastically improved their cost-to-income ratio. That resulted in a 123% jump in pre-tax income to 93.3 billion yen. This was driven heavily by a 41% sequential rise in equities revenue. Plus, a major milestone for investment banking, passing 50 billion yen in Q1 net revenue for the very first time. Okay, Section 3, Record Wealth Management Highs, Capitalizing on the Asset Management Nation. Now check out the recurring revenue assets for wealth management. Those are the solid red bars on the left. They climbed to a record 31.7 trillion yen. That upward red line, that's recurring revenue hitting 59.2 billion yen. The critical takeaway here isn't just the size, it's the consistency. 17 consecutive quarters of net inflows. This tells us this isn't a sudden fleeting macro spike. This is sustained, structural growth in a highly sticky segment. And that structural growth translates to some incredibly efficient profitability. Wealth management achieved a massive 49% pre-tax profit margin. Furthermore, their recurring revenue cost coverage ratio rose to a really impressive 76%. High margins like this demonstrate that the intense multi-year revitalization efforts, particularly in their international wealth management business, are finally providing a highly reliable, high-quality contribution to the bottom line. Looking forward, Nomura isn't just sitting still. They're aiming to expand the space by roughly 1.5 times, targeting 41 trillion yen by 2031. How are they going to do it? Well, they're heavily leveraging a newly launched banking deposit sweep service, which is already seeing steady contract growth. And they're openly considering strategic M&A to capture even more of Japan's wealth, really leaning hard into the country's broader push to become an asset management nation.
Section 4, The Japanese Market Tailwinds, the Macro Catalyst. You have to ask why this is all happening right now.
Well, the underlying catalyst is captured perfectly in this observation from InsightSphere. Nomura is riding a literal wave of record-high Japanese equity markets. When you see a 68% surge in the daily trading volume of cash equities on the Tokyo Stock Exchange, you know that volume is feeding directly and heavily into Nomura's equity products revenue. But it's more than just equities. What we are looking at is a perfect storm of favorable conditions. Rising yen interest rates are actually driving solid demand for Japanese bonds, with Nomura seeing bond sales jump 14%. We're seeing highly active corporate deal-making, especially in renewable energy M&A. On top of that, there's massive demand from hedge funds for financing that U.S. peers simply can't fully absorb right now. Add in heavy inflows into active Japanese and emerging market equity trusts, and you've got a macro environment absolutely perfectly suited to Nomura's specific business mix.
Bringing us to Section 5, Upgraded Targets for 2030, Surging Confidence.
This completely visualizes management's revised outlook. They've hiked their profit goal by 1.5 times, moving from an old 500 billion yen target to over 750 billion yen. They've also bumped their return on equity goal from an 8 to 10% range up to 10 to 12%, or even higher. What's genuinely fascinating for an analyst here is CEO Okuda stating this is achievable purely through the organic growth of existing businesses, without needing to rely on any radical, risky pivots.
To actually hit these new highs, Nomura's playbook looks remarkably strict and disciplined. They plan to monetize these market opportunities while maintaining rigorous cost controls. They are even absorbing their upcoming headquarters relocation costs. They're carefully balancing growth investments with shareholder returns, targeting a very attractive 40% dividend payout ratio, which could mean around 20 yen per share. And all of this is happening while they sit on a highly robust capital buffer, showing a 12.9% CET1 ratio that easily clears their 11% internal target. The structural reforms are clearly working, and the first quarter was frankly operationally brilliant. But with geopolitical risks heightening and monetary policy shifts in the West threatening to inject some severe volatility into the markets for the back half of the year, we have to ask a critical question. Can Nomura weather the coming volatility and maintain this upgraded trajectory? Or was this blowout quarter simply as good as it gets? The top-line numbers are pointing one way, but macro volatility suggests a storm could be brewing. Which side are you on? Do your own homework. Thanks for joining me on this explainer, and I'll see you next time.